This is Dire. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, Amazon just issued a massive warning. I'm going to show you what Amazon is warning about and why what's happening in Amazon is going to spread to every major tech company and every employer across the country. And the situation is so dire, it's going to affect each and every American household. Plus, if you'd like to make a 26% return in a month, I'll show you how our subscribers did it and how you can too. Stay tuned. Now let's head over to CNBC, where we picked today's story up with a headline. As Amazon Cloud Boss says, employees unhappy with a 5-day office mandate can leave. And this is something that we said was going to happen. When Amazon announced the return to office program, we said a lot of people were not going to like it, and this was just a move to get people to quit. And when you start to think about why this is going to affect every employer, because during the pandemic, we had a surplus of demand and not enough work. And unfortunately for the labor market, we've seen that shift now. And companies want to lay off, but they don't want to pay out severance packages. They don't want to pay unemployment benefits. So they're looking for ways to get people to quit. And one of those is to tell them it's time to come back to work. If there are people who just don't work well in that environment and don't want to, well, that's okay. There are other companies around. At Amazon, we want to be in an environment where we're working together, and we feel that collaborative environment is incredibly important for our innovation and our culture. Amazon has observed that working in office helps teams be more collaborative and effective, according to a company spokesperson. And no doubt that's true, that there is the effect here that they need to lay off people because companies like Amazon overhired during the pandemic. And it made sense because we had this huge surge in demand due to all the pandemic stimulus, both on the fiscal and the monetary side. And everybody bought into the narrative that the economy was going to boom, that after an already long expansion, that all it took was a pandemic to really unleash spending and demand in the economy. But as it turned out, as all that stimulus goes away, well, there really wasn't that much demand to begin with. Now we have a problem. Employers have overhired. They need to get rid of people, and they need to do it quickly. And again, return to office is something a lot of employees that are on a hybrid or home work schedule don't want to do. And employers know it, and they know it in a big way. The company is foregoing its pandemic-era remote work policies as it looks to keep up with rivals Microsoft, OpenAI, and Google in the race to develop generative artificial intelligence. It's one of the primary tasks in front of Garmin, who took over Amazon Web Services in June after his predecessor stepped down from the role. And there's the other issue we have here is this whole AI thing, because a lot of companies invested big money, billions of dollars into artificial intelligence, telling investors it was going to change the world, drive massive profits and revenue, and yet it's done virtually nothing. So far, we just have an overpriced chatbot, and that's about it. And on top of that, maybe it makes some great pictures here and then some other things, that the real issue is a lot of people aren't even using it. They don't even know it. In fact, when we look at companies like Facebook, they have a artificial intelligence deal. I have Facebook. I haven't ever used it, and I haven't used AI in a lot of other places. I've used some of it, but not to justify the billions of dollars that are being invested in it. And this is one of those cases where companies are going to have to justify all this expense. So why do they need people back at work? To figure out how to turn this AI investment into something very, very profitable. And the challenge here is the move has spurred backlash from some Amazon employees who say they're just as productive working from home or in a hybrid work environment as they are in an office. Others say the mandate puts extra strain on families and caregivers, and that's really the issue. The employees don't want to go back to the office if they don't have to. But the problem is everything has shifted into the hands of the employers. Again, back when there was actually too much demand, and for labor that is, what we saw is employers, they had no choice. They just hired. Now it's shifted. When we start to see unemployment rise, well, it means if you don't want to work, an employer can go get someone else. That's the challenge. Companies like Amazon know it. They know they've got too much staff, and if you don't want the job, it's no problem. They can find someone else very easily who does. And here we can see what's going on for employees is not exactly what they want. And you see the unemployment rate in blue has been rising here recently, although very slowly. Of course, according to the Fed, it's not going any higher, but we know it actually is, because when we look back and compare that to average hourly earnings of production and non-supervisory employees, which is shown in red on year-over-year rate of change, when you see a deceleration in wages, well, you tend to get a rise in unemployment, because what happens here is employers realize, I don't have to give out a big raises anymore. I do have to give out some raises, because if you don't want it or you don't want this job, well, I can just go to the unemployment line and find someone else. And we've seen this massive deceleration in wages. As we noted, demand is going down and more people are headed to the unemployment line, putting employers like Amazon in a position to command back to work and simply say, if you don't want to come back, you can leave. And they're not the only company that's saying that, as we now see Metre continues with its big layoff plans, as it now lays off employees at WhatsApp and Instagram. And Metre has slashed around 21,000 jobs since November of 2022 to keep costs low, with CEO Mark Zuckerberg calling 2023 the year of efficiency. And Metre shares have jumped more than 60% this year. In fact, its most recent second quarter results, Metre beat market expectations for revenue and issued a rosy sales forecast for the third quarter, signaling that robust digital ad spending on its social media platforms can cover the cost, and get this, of its artificial intelligence investments. So once again, you don't see Meta saying, hey, we're making money with AI. What they're saying is we're spending a lot of money with AI, but the good thing is we're making so much other money elsewhere, if we can afford to invest in this, and maybe someday it will turn into something, and hopefully we're going to be the leader of that. The challenge is all these tech companies, they really haven't had anything innovative, but right now the answer is simple. Slap the words AI on something, maybe consumers will buy it, but Wall Street is buying it in a big way. But that's not going to go on forever. These companies are going to get under pressure in the near-term future to generate revenue with AI. But if you're looking to generate revenue, well, we've got some AI power too, because we back tested our CTA Timer Pro. And let me show you how our subscribers made a 26% return. And this is going up higher even as we speak right now. And how did we know it? Because we trade against the machines. We know when the machines get in deep short positions and price moves against them, it triggers a buy signal on our reports. But our advantage is we ran a historical overlay. So we actually know at every level when the machines are wrong. Well, we back tested it to validate everything works. This was one of those reports, and coming soon, we're going to have even more signals generated to give you even bigger potential for return. We're going to show you how to do that. Here you can see today, uranium's up another 1% at the time of filming. And here's what you get. You get the daily report. You get tradable signals. You get my opinion on the best trades. You get the full backtest data. That's right. We give it to you so you can validate it. We give you stop loss levels, full tracking of trades and returns, a weekly update, a fully duplicatable system, and coming soon. Not only are we giving you a 30-day free trial right now so you can jump on board, but our development team is going to take all the high-value back-tested trades. We're going to have a separate page for that on the report just for you, so that way you can trade only the highest probability trades. Links in the description below. It's $30 a month, and best part, 30-day free trial. Start making money like our subscribers. Because as we turn to the housing market, we see further pain. So you look at what's happening in the tech space. You have this big AI investment that hasn't really done anything. You have over hiring, and now companies are looking to shed jobs, and that's going to filter all throughout the economy, and then it's going to impact the housing market. Now we're seeing it impact it right now, but why is housing so important? Because when you lose the housing market, you lose your economy, and that's why it's so critical, because of all the jobs tied to it. And now we're starting to see a decline in housing starts hit multifamily construction, as construction slipped 0.5% in September to 1.35 million. And starts of single family homes climbed 2.7% to an annualized 1.03 million. But here's the problem. Multifamily homes slumped 9.4% to a 4-month low. And one of the issues facing the housing market right now is due to all the cheap money from the pandemic. What we saw is a huge surge in building of multifamily units. They just went up everywhere, and that created a ton of jobs. The problem is we don't have enough people to live in them. In fact, that's what we're seeing as units are completed. They're fighting with existing units to pull some of their tenants over because there aren't enough new tenants. And when you have the economy slowing, well, it gets even worse. And what this means for the labor market, well, there's going to be more job losses, just like we're seeing at Amazon and Metre. The number of overall building permits, a proxy for future construction, fell 2.9% to 1.43 million. Permit applications for single-family home construction rose 0.3%. But there's a big problem here, because after the Federal Reserve boosted interest rates to the highest level in decades, demand weakened and ultimately left home builders with the largest supply of new homes in 16 years. Now, what's odd here is home builders are super optimistic. They think something like a 0.5 point rate cut is going to cause a huge surge in demand, because the only issue with housing right now is the fact that rates are slightly too high. The issue here is the economy is slowing. What we're seeing happen at Amazon and Metre and other companies is only going to get worse. And when people lose their jobs or see their hours work get cut or see their coworkers lose their job, they don't get too optimistic about buying a house because they're afraid they won't be able to make the payment. But at the problem here, if you look at the housing market, you have the biggest inventory in 16 years at home builders, which means if we don't see those sell, they're going to start to discount. And with a lot of people looking to sell their homes in the future, what that's going to mean is going to drive prices down and put a lot more Americans out of work. And here we can see what's facing the housing market is the unemployment rate. Because as we look at new privately owned housing units started shown in blue against the unemployment rate, what we can see is that you get a slowdown in housing starts, but ultimately there is a point where they continue, and that starts to affect the labor market. You see it happen here around 2000 again. And as we go into the global financial crisis, housing starts decline quite a bit before it really started to impact the broad economy. Now we're seeing them almost lockstep together, which tells me the issue isn't about interest rates. It's about the economy, because if the economy was booming, well, consumers could afford higher prices, could afford higher interest rates. The problem is they can't. A sustained housing recovery will take time, as mortgage rates, which hit a 2-year low in mid-September, have recently picked up. Nonetheless, builders on recent earning calls have been upbeat about the prospect of cheaper home financing costs after the Fed cut interest rates by 0.5 point last month. And if you think about their position, if you're sitting on the largest inventory in 16 years in your industry, well, then you need any hope. And hope right now is maybe an interest rate cut. But what builders are going to find out is that a cut in interest rates isn't going to bring all the buyers they think. Because if we look at 30-year fixed mortgage rates against housing starts, what we see is mortgage rates in red, as they go down, it didn't change things going into the 1990s recession. In fact, lower rates really didn't spur much of an increase in demand. But the opposite happened in 1998 when housing starts started to slow and interest rates went up, and then interest rates came down, and that sent housing starts soaring. But as they came down around 2007, it took a while before the interest rate market started to respond, and then interest rates fell, and you see housing starts absolutely plunge. And then you see around 2019, lower interest rates did spur the housing market going into the pandemic, but this time lower interest rates haven't changed much. So the idea here that a further decline in interest rates, which notably the long end of the curve was already leading the Fed, was going to help these home builders, was going to save the housing market, doesn't appear to be the case, because what it's suggesting is there's something much worse going on with the economy. But affordability is still a pressing issue in many regions, as home building will likely remain stagnant until the Fed is well into its easing cycle and mortgage rates have fallen another 1% point. I think it's going to take far more than another 1% to cause housing to come back, because again, it all comes back to the labor market. So you think about what's happening at Amazon. They have too many employees, need to get rid of them. Metre cutting employees. Other employers are going to look to do the same as demand is going down. We're going to see people lose their job in the housing market. And then we turn to this slide where we talk about incomes, because here's the real issue. When you look at total income, which is a function of average hourly earnings multiplied by average weekly hours of production of non-supervisory employees, and this is shown in red on a year-over-year rate of change. And when people can afford to buy a home, well, it's because their incomes are usually rising. So you go back here kind of into the early 1980s, what do you see? Income growth is slowing, housing starts rise, you see a buildup in inventory, and then next thing you know, housing starts come tumbling down. Incomes come back a bit, but not enough to change the trajectory of the housing market. We come forward to around 1996, 1997. What do you see? Income growth coming off a pretty hot level, right around about 5%. It starts to slow. Housing starts continue to rise until it does affect the housing market as incomes continue to slide. And then coming out of course, the dot-com bubble, what do we know? Housing starts to rise, but this is builders anticipating what they're doing now. You build it, they will come. but income growth stayed around 2 to 3%. It wasn't enough. Next thing you know, housing starts come tumbling down. And then, of course, it eventually hits the housing market itself. Total incomes across the board are plunging. This time, you see incomes going down. You see housing starts going down. And yet you see builders being optimistic. I think builders got this wrong. The only risk is for people trying to sell their home or planning to eventually sell their home, they're going to be competing with a huge market from the builders who have a lot of margin to cut. But when we talk about housing destroying the economy, all we have to do is turn to China to see where we're headed here. As China home prices slump drags on despite revival efforts. And on a year-over-year rate of change, we can see that new home prices compared to a year earlier tumbled 6.09%. But get this, where new home prices go, well, that means existing home prices are going to fall even more, down 9.02% from a year ago. And Beijing is struggling to arrest the property sector decline at a time when deflationary pressure is adding to the economic gloom. And China on Thursday pledged to nearly double the loan quota for unfinished residential projects and plan to renovate 1 million homes in older rundown dwellings in large cities. The plan underwhelmed with investors looking for stronger policies. But what you see happen in China is exactly kind of what happened to companies like Amazon during the pandemic. Of course, China, they built all these homes thinking if you build it, people will come. The problem is people didn't come. Now they have a huge surplus of empty homes, nobody to buy them, and of course you don't need workers to keep building new homes if you can't sell the ones you have. You look, of course, at big tech. They've convinced the world AI is the next thing. They're realizing it's not doing anything. They've got too many employees. They need to shed them because if you can't turn AI into something profitable, well, eventually it's going to impact the stock price, but in the meantime, it's going to impact the labor market, and we're seeing demand go down across the board because everybody built up inventory. Everybody thought demand was going to continue until they realize now it's not. And when you look at what's going on in China, you can see deflation is not good for the labor market because that is the underlying story of what's going to affect every American household is that the labor market's going to fall apart. Here we look at the unemployment rate. As we see it rise, what happens? Demand goes down. Of course, China facing deflation. Well, we can go to the global financial crisis. We see deflation was not good for the labor market at all as price growth collapsed, and that sent, of course, demand down and unemployment rising. You see the same effect happening at the dot-com bubble, and you see the early phases of it now. The difference is most people believe there's no way the labor market here can fall apart. But what we're seeing in China with the housing market is something that's going to happen in the U.S. And it makes perfect sense when you think about 16-year high in inventory. And then you look, of course, the big tech companies laying off. It's all a perfect storm. And the property sector will continue to be a drag on the world's #2 economy due to the negative impact on household wealth, of which 70% are in property. I think the real issue is Chinese workers are out of work and they're looking at the global economy and they're not seeing a lot of demand. And if that's the case, why would you buy a home? And new home prices fell 6.1% in September, steeper than August's 5.7% drop. Existing home prices decreased 9%. But look at this, residential sales slipped 8.7% in September from a year earlier, though the decline narrowed from August. The latest steps to revive the housing market led to improved sales in the first 2 weeks following the stimulus blitz announced last month. And what we noted was that would likely pull forward some people who were looking to buy anyways, but broadly speaking, it wasn't going to change the picture. And then you start to look at what Beijing's trying to do to save things, and you realize they're going to all the wrong places at all the wrong times. It's China's latest move to support markets after data showing economy slowed. That's right, they're looking to pump the stock market rather than the actual underlying economy. The PBOC disclosed more details of its measures to boost capital market minutes after authorities released figures showing China's slowdown deepened in the third quarter. At a separate event in Beijing, the PBOC Governor Pan flagged the real estate and stock markets as key challenges in the economy that require targeted policy. Just goes to show they don't realize that if you want to get your economy to go, it's not just about getting people to buy homes. It's not about stock prices going up. It's about putting people to work and giving them wage growth where they feel the confidence to go out and spend. And data released before Friday underscores those challenges. And here you can see China, world's largest exporter, as exports in September slowed sharply. Curbing a trade rebound has been the highlight of the economy. Deflationary pressures continue to build with consumer prices still weak. and factory gate prices falling for 24 straight months. And so when you lose your export market as the world's largest exporter because the global economy is slowing down, just like we see at Amazon, just like we see at Meta, just like we see, of course, in the housing market, what it says is millions of Americans, millions of workers all around the world are going to lose their jobs. And so that's why we say what's happening on Amazon right now is going to impact every American household in a matter of months. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.